All right, so Varun Lohchab is joining us now to talk more about markets. Varun and team have recently released their new report as well on Outlook 2024, taking stock of the market and opportunities here. Varun, afternoon. Thank you so much for your time. Varun, before we go deeper into the market and parts of the market, just want to get your thoughts and the team's thoughts on the valuation of the benchmarks as well as the kind of valuation the broader universe is trading at, because there's continuous debate on whether we are expensive after the recent rally or we are not. What is the earnings picture looking like? So why don't you share your thoughts around that?
Sure. Yeah, thanks for having me on the show. So overall valuations are definitely on the higher side. If you look at Nifty, it's trading at around 20 times on FY25 after the recent 10-12% rally since October end, which is higher than averages, almost one standard deviation higher than long-term averages. But it's not in a I would say bubble zone. Typically, markets do tend to go sometimes to two standard deviations higher, and then it tends to fall off the cliff. So I don't think we are in a situation where it demands a very steep correction. But from current valuations, I think the upside looks fairly limited at index level for next year. What we were expecting for calendar year 2024 actually came in the last 1-2 months itself. Another 8 to 10% on is possible for next year, but double-digit returns from here on looks difficult for the next calendar year, given where valuations are sitting. Because earning growth, we believe next year is going to be in low teens at best, because most of the sectors have completely normalized their earnings in FY24 itself. So be it banking, be it autos, the two sectors which were really pulling up the earning growth in FY24, and even oil and gas. So from these elevated level of earnings, it would be difficult to grow anything beyond that. And with some P compression, which is possible, returns could be more, high single digit for next calendar year.
Varun, which part of the market do you see strength in earnings? And they may not be fully in the price. I want to understand margin of safety. In this kind of a market, where do you see highest margin of safety?
So see, margin of safety will come from two aspects. One could be from the earning growth perspective. Second could be from a valuation support perspective. In terms of if I look at, say, banking or large banks in particular, I think they are looking good from both perspective going into CY24. So we have recently increased our weight and now gone slight overweight after a long time on banking. Because next year also we are projecting a 15% earning growth for banks, despite the NIM compression which is already being built in. And given the fact that valuations are below long-term averages, that is one sector which is looking fine. I think IT also provides a decent margin of safety. Valuations are fairly reasonable out there. And by second half of of the coming calendar year, we expect some pickup in demand for IT companies. So I think that these two large sectors do present some margin of safety. Barring that, I think some of the value sectors like oil and gas is still looking decent to us from a margin of safety perspective, be it OMCs, be it some of the gas companies, and even the upstream and refining companies. So yeah, these are, I would say, relatively the pockets of where the margin of safety is better.
One quick word on the consumption space, especially QSR and the bottlers or beverage companies. We are seeing a clear kind of a slowdown, of course, in QSR, but still they haven't really stopped their capex, the store additions. In fact, Varun has just forayed into South Africa. Devyani wants to go to Thailand. I was speaking to Sapphire Foods also yesterday on this very show. Though they were unclear of when the volumes will turn around, the SSG, etc., but still they are not slowing down on their capex. Does it kind of show that medium to long term, if one were to take a call, these guys are confident of volumes coming back? How do you read this back?
Exactly. So I think that is precisely the case. The QSR companies are taking a medium to long term view on India consumption story, and therefore they are continuing to add stores even in a downturn, because if you look at last 2 or 3 quarters, SSG has been quite muted for these players. And margins are getting hit because of continued store expansion, because of the negative operating leverage of the new stores. However, if you take a 3 to 5 year view, and we have seen that in the past also, that in the next upcycle of demand, all of these new stores which were opened up during the downturn do tend to reward you, during an upturn, and the payback periods are quite good if you look at through the cycle. So I think it's a right strategy as long as balance sheets are supporting that. I don't think balance sheets are a concern for these QSR companies, and therefore they are taking a medium to long term view. In terms of overseas expansion, I think it's looking like there is a great valuation arbitrage, or there's a huge difference in valuations for the same brands in some of these international markets vis-a-vis Indian markets. And that's where these management teams believe that if they acquire them cheap, and if they can improve the operating performance given their expertise in the space, they can create value. So I would not get overly excited, because there's a reason why those businesses trade at those valuations in the international markets. But if over a period of time these managements are able to add value and improve the margin profile for some of those businesses acquired in Thailand or South Africa, then there is upside to be had in terms of earnings.
Great. How are you playing the entire lenders pack, Varun? The large cap, the mega caps, be it NBFC, which are taking it on the chin because of some regulatory development. Where is the growth versus safety lie in your view? PSUs, PSU banks?
Yeah, I think so. Compared to say last 2 or 3 years, when there was a clear sort of a preference for one sector, so we were preferring banks over NBFCs till 6 9 months back, and within banks, obviously PSU banks were looking more attractive at the start of previous year. Now I think those most of those things have got normalized. So from here on, it's more about individual stock picking than even sector picking. If I look at large private sector banks, they are looking fine after the de-rating. If I look at PSU banks, they are also looking okay despite the re-rating, and now they are at 0.9 one-time price to book, which is still not expensive given the fact that there is no big credit down cycle that we are expecting in PSU banks anytime soon. Similarly, NBFCs underwent a lot of pain period from 2019 to 2021, 22, and now with interest rates peaking, we believe some of the select NBFCs will also do well despite RBI taking a stricter view on some of the NBFCs which are into unsecured lending and growing at a very fast pace. So it's very, in fact, after a long time, we are sort of, I would say, neutral to positive on all three segments, be it private banks, be it PSU banks and NBFCs from a 6 to 12 month perspective. But you have to do your stock picking. It's not that all NBFCs or all PSU banks or all private banks will do equally well. So it's more about stock selection now rather than sector selection for the next 12 months.
Okay, sure. One quick word. Varun, the universe of companies which you have under your coverage, the large cap, mid cap, all of them put together, I want to understand what's the earnings profile and outlook looking like. One section of the market said that or believes that December quarter result onward, which is just starting off, because of high base, the numbers may start looking on the lower side, weakish side. But still, then there is a market street believes that no, earning momentum may continue very well. So, how's the visibility of your universe looking like?
So see, when I look at our coverage universe, it's almost 220 odd stocks. So it covers all sectors and actually all market caps. There is going to be a clear deceleration or slowdown in earning growth in FY25 compared to FY24. If you look at FY24, for our coverage universe, we are getting around 28% earning growth, largely due to say very strong earning growth in oil and gas, which was coming from a depressed profitability in FY23. But even other sectors, because of the margin expansion, you have seen a very strong FY24, which will not continue into FY25. Starting Q3 and more so Q4, the margin story will be in the bag, in the sense that it will start getting anniversarized and you will no longer see margin expansion. So FY25 actually for our entire coverage universe, we are only getting a 8% earning growth because for oil and gas OMCs, we are building in a slight deceleration. But even if I X out energy sector, it's around 14 to 15% sort of earning growth for FY25, which is much lower than what it was for FY24. So that's why I said, it's looking difficult to get a double digit sort of an upside in market from current levels for FY25, given the fact that earning growth won't be robust because, the two sectors, say BFSI and autos, which contributed in a big way in last 2 years earning growth, which is FY23 and 24, they will now not be growing at 40, 50, 60% the way they were growing in terms of earnings because profits have normalized out there. Corporate profitability is already back to sort of historic peak levels.
All right, Varun, we'll let you go on that one. Thanks so much for joining us on the show today. That was Varun Lohchab of HDFC Sec. We'll take a